Imagine waking up tomorrow morning to a headline. All governments have agreed. Debt has been erased. Interest canceled. A new era begins. It sounds like a utopia, but in reality, this would be one of the most dangerous scenarios for the global economy. Because debt is not just a problem of governments. Debt is the foundation of the financial system. Remove the foundation, and the building doesn't collapse slowly. It collapses all at once. Today, we'll break down what would happen if debt truly disappeared, why resetting debt is far more destructive than it seems, and why almost every reform ends with even more debt than before. Let's start with a simple but uncomfortable truth. Every person's debt is someone else's asset. If a government has bonds outstanding, those bonds sit on someone's balance sheet as a safe asset. For banks, they're collateral. For pension funds, they're the foundation of payouts. For insurance companies, they back reserves. For central banks, they anchor stability. So eliminating debt doesn't mean removing a burden. It means destroying assets on a scale of trillions of dollars. And that's the central paradox. What looks like liberation is, in reality, the largest capital contraction in history. Why is everything built around debt? Because the modern monetary system grew from a simple idea. Governments borrow, and money is created on top of that borrowing. This began with models like the Bank of England, where government debt became the foundation of money and credit. Over time, financial markets turned debt into a universal commodity. It could be bought, sold, used as collateral, and layered into complex derivatives. At the same time, large corporations, following the Rockefeller logic, built vertical and horizontal monopolies, while financial infrastructure supported capital concentration. Whoever controls capital controls scale. And that's how we arrived at a world where governments constantly refinance themselves, corporations consolidate entire industries, and a reserve currency holds the system together through trust. This isn't a conspiracy. It's architecture. Now let's simulate it. Debt is erased. Several things vanish immediately. The risk-free rate government bonds are the benchmark for credit pricing and asset valuation. The collateral base, a massive portion of the financial system relies on collateral. Government securities are the ideal collateral. Bank and fund capital. When assets are written down, capital shrinks, and lending contracts, which means debt elimination instantly becomes trust elimination across financial balance sheets. The first effect is deflationary. When assets and collateral disappear, banks all behave the same way. They stop taking risks. Credit is the bloodstream of the economy. When credit contracts, a chain reaction begins. Fewer loans to businesses. Production declines, fewer loans to households. Demand falls, turnover drops. Incomes fall. Insolvency rises. Prices don't fall because things are cheaper. They fall because money stops circulating. It may look like a cleansing, but it feels like an economic shock. The second effect hits assets. Pension funds, insurers, and conservative portfolios hold massive amounts of government bonds. They don't chase returns like hedge funds. Their job is stability. If government securities are erased or sharply devalued, these institutions face a simple reality. They can't meet their obligations. Then comes the domino effect. Funds sell other assets to plug the whole stock, and real estate markets take a hit. People see prices falling and panic, liquidity dries up, and the worst part is how fast it happens. The second effect hits assets. Pension funds, insurers, and conservative portfolios hold massive amounts of government bonds. They don't chase returns like hedge funds. Their job is stability. If government securities are erased or sharply devalued, these institutions face a simple reality. They can't meet their obligations. Then comes the domino effect. Funds sell other assets to plug the whole stock, and real estate markets take a hit. People see prices falling and panic, liquidity dries up. And the worst part is how fast it happens. Then comes the domino effect. Funds sell other assets to plug the whole stock and real estate markets take a hit. People see prices falling and panic liquidity dries up. And the worst part is how fast it happens. Now back to reality. A global debt wipeout is fantasy. But local defaults are very real. The problem is interconnectedness. One default changes risk premiums, interest rates shift, debt servicing becomes more expensive for everyone. Weaker players fall one by one. So, the system constantly chooses the lesser evil, not eliminating debt, but pushing it forward in TI. Then comes the domino effect. Funds sell other assets to plug the whole stock and real estate markets take a hit. People see prices falling and panic liquidity dries up. And the worst part is how fast it happens. Then comes the domino effect. Funds sell other assets to plug the whole stock and real estate markets take a hit. People see prices falling and panic liquidity dries up. And the worst part is how fast it happens. And here's the main conclusion. From an individual perspective, it seems obvious. Just stop borrowing. But within the system's architecture, debt serves critical functions. Collateral money creation, trust, anchoring income for capital holders, crisis management. That's why reforms usually do just one thing. They make debt manageable, but permanent. Which explains why after every crisis, debt doesn't disappear. Debt grows, large institutions become more powerful. So what would happen if debt disappeared? In short, the financial system loses its base asset and collateral credit contracts. Deflationary shock, pension and insurance balance sheets collapse, markets sell off. Asset prices fall. Governments respond with emergency centralization. The paradox is that the debt system feels like a prison, but the exit isn't a door. It's an explosion through the wall. And that's why the system isn't destroyed. It's extended. As long as trust remains. The next logical question is this. If debt can't be eliminated without catastrophe, how does the system reduce pressure? Historically, there are three methods. Inflation, restructuring, currency regime change. That's what the next video will cover. Which of these scenarios is closest right now, and why?